Earned income credit. The credit everyone wants. Earned income credit is a tax credit for working individuals with earned income below the threshold amount. The credit reduces tax liability, but if it exceeds the tax liability, it is refundable. It's one of the most frequently miscalculated credits, and the IRS looks very closely at this credit. As a preparer, you must exercise due diligence in determining eligibility for the credit. The IRS can penalize a preparer for failure to follow due diligence. To claim the credit, a taxpayer must meet certain tests. Income rules, they must be below the income threshold. Citizenship, they must be a U.S. citizen or resident alien all year. Tax identification number. Everyone on the return must have a valid Social Security number. I-10 numbers are not allowed for earned income credit. If there is one I-10 on the return, then the credit will not be given. Filing statuses. All filing statuses get earned income credit except for married filing separate. A taxpayer must file a return to claim the EIC, even if the income is below the filing threshold. No tax withheld, or the taxpayer did not owe any tax. This is for people that make under the amount of their standard deduction plus their personal exemptions and dependent exemptions. If they made below that amount, they can still file a return to claim earned income credit. Income qualifications. To get the phase-out ranges, to get the max EIC for single, qualifying widow, head of household, no children, one child, 2 children, or 3 children. The first number is the max amount you can make and still get the max amount of credit. From there to the second number is the max that you can make and still get a little bit of earned income, even though it's going to be decreased because you're above that. Same thing with married filing jointly. So if a person has 3 kids, they're single, they made $16,690, they're going to get the max credit. If they made $43,998, they're going to only get maybe $1 in credit. It's like a pyramid. It starts out low at $1 of earned income and goes all the way to the top numbers on this chart. But it's like a big hill. It starts going up, and then it peaks, and then it starts going back down again. The income must always be earned income. Can never be unearned income such as interest, stocks, bonds, passive activities. And investment income must not exceed $3,150. Other qualifications, of course, is citizenship. I went over that just a minute ago. The taxpayer identification number and the filing status. Besides AGI and earned income, the amount of EIC depends on the number of children the taxpayer has. The taxpayer's child must pass the qualifying child test. Relationship must be son, daughter, grandchildren, siblings, brother and sister, or niece and nephew. It cannot be anybody else. They have to be under 19 years of age. Unless they're in college, they can be under 24, or if they're disabled, they can be any age. The main taxpayer on the return must be older than the child they are claiming. Residency, they must have lived with you more than half the year, and they cannot be filing a joint return unless it's just to claim a refund. Taxpayers with no qualifying children can still get EIC, but there are some additional rules. They must be at least 25, but under 65, cannot be a dependent on somebody else's return, cannot be a qualifying child for anyone else and must have lived in the United States for more than half the year. There are people that cannot claim the credit. People whose filing status is married filing separate cannot claim it. A qualifying child of another person, a dependent of another person. Somebody that claims foreign income exclusion or a deduction or exclusion for foreign housing. A taxpayer whose EIC was disallowed or reduced in previous years due to reckless or intentional disregard or fraud. To figure the credit is figured by looking at the amount on an IRS table. That table is found in the 1040 instructions. It's based on the filing status, number of children, if any, and the income determined from the EIC worksheets. To claim the EIC, earned income must be less than the earned income limit amount for the taxpayer's filing status and number of children. The earned income limits are below in this chart. So if they made more than what's on this chart, then they cannot get the earned income credit. If you were previously disallowed for EIC, there is a period of 2 to 10 years before EIC can be claimed again. The 2-year period applies for an error due to reckless or intentional disregard of the rules. A 10-year period applies for in cases of fraud. A taxpayer whose EIC was previously disallowed or reduced for any reason other than math or clerical error must complete a Form 8862. Preparers have responsibilities. It is the preparer's responsibility to exercise due diligence in completing a tax return on which EIC is claimed. Failure to meet due diligence requirements can result in $500 preparer penalty for each failure. Use Form 8867 for each client claiming the EIC. Part 4 of Form 8867 contains the checklist for each of your due diligence requirements. Due diligence is very, very important. It's mainly stating that you know that they weren't lying to you. If you have any indication that what they are telling you is not correct, you are required to ask questions. Document those questions and document the answers. Right? You need to make sure you take notes. So you have a 19-year-old come in, claiming their 17-year-old sibling. First question, where are the parents? If they say the parents are no longer alive, they're in jail, live with them. The next question, did you provide more than half of this person's support? Why wasn't the parent supporting this child? You go until you get the answers you need to make a reasonable assumption that what they have told you is correct or incorrect. You believe it's incorrect, you have to refuse to put the EIC on the return. Not only do you risk a $500 penalty, but now they have made it where the owner of the company can have up to a $1,000 penalty per violation. So that's up to $1,500 in penalties for every violation for EIC. If you've done 15, 20 violations in one office, it's going to cost a lot of money. Thank you and have a wonderful day. Earned versus unearned income. What is the difference? Earned income is income that you've actually went out and earned. It can be form of wages, salaries, your own business, or cash payments. It also includes workers' compensation and combat pay. Usually, all income is taxable, but there are certain situations that may be tax-free. Workers' compensation is not taxed, and combat pay is not taxed. Your W-2 reports your salary and your income. 1099 miscellaneous is for your contract self-employment labor. Your combat pay has a special, I'm trying to find the word, a special bonus sometimes. Your combat pay is the pay you receive while in an active combat area. You receive combat pay, yeah, you don't have to pay taxes on it, you don't have to put it on your return, but it might be helpful to put it on that return. Say you made $5,000 regular pay and $10,000 in combat pay. You have a couple of children, you're married. You'll qualify for EIC at $5,000, but you won't get much. If you add that combat pay in and make it $15,000, you would get more earned income credit. Next, we're going to talk about unearned income. This is income from sources such as banks and insurance companies, money that you make from selling stocks, money that you're not actually out there actively earning. Also, unemployment is unearned. Retirement is considered unearned income. Money received from lawsuits, unless it's for paying medical bills or lost wages, then it's not taxed. But any other money from lawsuits is unearned. Sale of stocks, as I said before, is unearned. Generally, all is taxable just like earned income. There are exceptions. Certain interests on bonds, like municipal and state bonds, are not taxable. Savings bonds that actually used for education are not taxable. Next, I'm going to show you some forms. A W-2 form is something you will see a lot during the tax season. These are taxable wages. Now, if they have non-taxable combat pay, it will be in box 14. The next one is the 1099 miscellaneous. This is for your self-employed people. Now, just because they say they're self-employed don't mean they will have a 1099 miscellaneous. Some just receive cash and they never receive this form. In that instance, you'll want them to write down everything they brought in for the year's income and all their expenses and have them sign it so you can keep a record of it. Next is unemployment. 1099Gs. Unemployment is unearned income. A lot of people have gotten upset. They're used to getting earned income credit and they lose their job and they go on unemployment. They make $15,000 in unemployment. They come in to file their taxes because they have to pay taxes on it. They're thinking they're going to get the earned income credit. You cannot receive earned income credit with unemployment because it's unearned income. Next is a 1099 INT. This is what you see from banks. And when you have savings bonds and stuff that gain interest, you will receive one of these statements. Next are retirements. The first form I have is a 1099-R. It is taxable. There's a certain part of it might be taxable, other parts might not be taxable. It all depends on the age of the person, how much, if they have paid in out of their wages after their wages were taxed, or if it was not taxed and put in. So when you have gross distribution, that's the whole amount they got for the year. 2A should tell you how much of it was taxable. Say we have a gentleman who started his own IRA account. He gets paid every week, taxes are withheld, and he takes part of that money and puts in his IRA. When he starts drawing it at retirement age, it will not be taxable. On the other hand, we've got a gentleman that had a 401k. Every pay period, work put in. He had him take a amount out of his check and put into that 401k. but it was put in before his income was taxed.